The bond market is sending distress signals. The 10-year Treasury yield has dropped to 4.28%, its lowest level since mid-December, reflecting growing concerns about slowing U.S. economic growth. At the same time, inflation remains persistent at 3%, complicating the Federal Reserve's ability to respond effectively. The combination of declining yields, persistent inflation, and mixed economic signals presents a complex and potentially dangerous macroeconomic environment, one that closely aligns with what the Economic Reality Insight, or ERI, has been warning about. The ERI, designed to measure real economic risk, has dropped to 0.245, historically associated with pre-recession conditions. While some analysts focus on headline data such as unemployment at 4% and a slight expansion in manufacturing with ISM greater than 50, these figures mask underlying fragilities. The bond market, one of the most reliable indicators of economic expectations, is flashing signals that investors expect lower growth ahead. The question is whether this represents a temporary adjustment or the early signs of a much larger economic downturn. Why are bond yields falling? The recent drop in Treasury yields reflects shifting investor sentiment. Over the past month, a string of weak consumer and business sentiment reports has led many to revise their growth expectations downward. Investors are betting that a slower economy will force the Federal Reserve to continue cutting interest rates, despite lingering inflation. This has weakened the US dollar, which is now down 2% year-to-date against a basket of its global peers. Historically, falling bond yields indicate a flight to safety, with investors moving capital into government debt due to concerns about economic stability. But the current situation is unique. Growth is slowing, but inflation expectations remain elevated. The Federal Reserve is under pressure to cut rates, but doing so could reignite inflationary pressures. Trump's economic policies, including tariffs and government spending cuts, add layers of uncertainty. The bond market is pricing in economic stagnation, not a rapid recovery. This is where ERI becomes an essential tool, capturing the reality beneath the surface-level economic indicators. The yield curve. A critical economic signal. One of the most important indicators to watch is the yield curve, which measures the difference between short-term and long-term interest rates. In a healthy economy, long-term yields are higher than short-term yields, reflecting expectations of future growth and inflation. However, when the curve flattens or inverts, it signals economic distress. Currently, the 10-year Treasury yield is declining, while inflation-adjusted Treasury yields, or TIPS, have also dropped. This suggests that investors expect weaker economic growth in the coming months. Inflation concerns persist, even as economic activity slows. The Federal Reserve is likely to cut rates, but not aggressively. ERI takes this into account. Historically, when the yield curve steepens after a prolonged period of inversion, it has preceded recessions rather than signaling recovery. This is exactly what happened before the 2000 dot-com crash and the 2008 financial crisis. What role does inflation play? Inflation remains the most difficult challenge for policymakers. Despite falling bond yields, inflation expectations are creeping higher, driven by rising energy costs, persistent wage pressures in a tight labor market, and new tariffs under the Trump administration that could push prices up further. The latest CPI data showed inflation holding at 3%, which is still above the Fed's target. Normally, in a slowing economy, inflation would be expected to fall, but the opposite is happening. This means the Federal Reserve is caught between two opposing forces. If it cuts rates too aggressively, inflation could resurge, reducing consumer purchasing power. If it holds rates steady or raises them, it risks slowing the economy, even further worsening business sentiment. The ERI model suggests that this policy dilemma increases economic instability, reinforcing the risk of stagflation, a period of slow growth and persistent inflation. Trump's economic policies a wild card. President Trump's return to office has introduced new economic uncertainties, adding further volatility to markets. Tariffs on imports are expected to raise consumer prices, worsening inflation. Immigration restrictions could lead to labor shortages, pushing wages higher but slowing overall economic expansion. Public sector job cuts could reduce spending power in key areas, dampening consumer demand. Each of these factors plays into the broader economic picture, making it harder for the Federal Reserve to accurately respond. The ERI model accounts for these policy shifts as risk factors, indicating that while some sectors may benefit in the short term, the long-term stability of the U.S. economy remains fragile. The bond market's movements align with ERI's declining trend, reinforcing concerns about economic fragility. The implications of these trends are significant. Economic growth could stall. Falling bond yields suggest that businesses and consumers are becoming more cautious. If hiring slows, unemployment could rise, weakening consumer demand further. The Fed's ability to respond is limited. Lower rates may not be enough to stimulate growth if inflation remains elevated. This could force a new round of quantitative easing, or QE, to support the economy. Market volatility is likely to rise. Equity markets have remained resilient, but this could change as investors digest weaker growth data. The S&P 500 has already lost ground in recent sessions, a sign that risk sentiment is shifting. The yield curve will be a key indicator. If the yield curve continues to steepen after inversion, it could indicate an incoming recession. ERI will be closely tracking this development to assess the real risks ahead. The drop in bond yields is not a sign of confidence. It is a warning signal. Investors are preparing for slower growth, persistent inflation, and an unpredictable economic policy environment. The ERI remains at a concerning low of 0.245, reflecting increased fragility in the U.S. economy. The key takeaway? The bond market rarely gets it wrong. When yields fall this sharply in the face of high inflation, it signals that the economy is entering a dangerous phase. What to watch next? The next Federal Reserve meeting and its response to these shifting indicators. Inflation data in the coming months. Will it fall, or will it continue rising? The yield curve's movement. Will it continue to steepen, or does another inversion lie ahead? Stay ahead of these trends. Follow our Economic Reality Insight, ERI, for real-time updates on where the economy is heading next.